Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. We're at a critical inflection point in Q1 2026 where two dominant narratives are competing for control of your portfolio returns. On one side, an AI-driven earnings supercycle is pushing the Magnificent Seven to substantial outperformance. On the other, Federal Reserve policy remains cautious following three consecutive rate cuts throughout 2025, creating uncertainty about the monetary trajectory ahead. The question every trader is asking, which narrative wins? Let's start with where the Fed stands right now. Federal Reserve Chairman Jerome Powell has characterized current policy rates as being within a plausible range of neutral. That's Fed speak for, we're done being aggressive, but we're not committing to anything. The central bank delivered three consecutive rate cuts in 2025. And as of today, they've shifted to a distinctly data-dependent stance. No predetermined path, no forward guidance you can bank on. According to Santander Private Banking's analysis, market participants are currently pricing in two potential rate cuts for 2026. The projected policy rate range is expected to settle between 3.25% and 3.5%. with inflation metrics converging toward the Fed's 2% target. That's the dovish case. But here's the catch. The timing and magnitude remain highly uncertain. Any deviation from expectations could trigger significant volatility across growth stocks, particularly the AI-focused names that have led this rally. This measured Fed approach has created a bifurcated market environment. Growth stocks, especially AI plays, continue benefiting from the relatively accommodative conditions established last year. But simultaneously, we're seeing noticeable rotation toward defensive bond positions. Investors are hedging against potential policy missteps or unforeseen macroeconomic shocks. That's not the behavior of a market with full conviction in the growth story. Now let's talk about the AI earnings supercycle because the numbers here are compelling. The Magnificent Seven, NVIDIA, Microsoft, Alphabet, Tesla, Apple, Amazon, and Meta are driving substantial earnings momentum. According to Yahoo Finance reporting, consensus projections for this group have been revised upwards significantly. Earnings growth expectations rose from approximately 14% to roughly 18% for 2026. That substantially outpaces the broader S&P 500's projected 11% expansion. The capital expenditure surge supporting this thesis is real. Alphabet initially forecasted $75 billion in CAPEX for 2025, but subsequently increased that projection to $85 billion due to growing demand in AI and cloud services. That's a $10 billion upward revision, signaling accelerating investment in infrastructure to support AI workloads. This pattern of increasing AI-related investment is evident across multiple technology companies, providing fundamental support for the supercycle narrative. Let's get specific on individual company performance because the details matter for trading decisions. Apple reported a 23% jump in iPhone revenue, accompanied by a remarkable 38% increase in China revenue, as reported by the South China Morning Post. That China number is particularly significant given the competitive pressures Apple faces in that market. However, CEO Tim Cook has warned of potential margin pressures due to elevated memory chip pricing. Even strong performers are dealing with input cost challenges that could compress margins going forward. Tesla presents a mixed picture. The electric vehicle manufacturer beat both earnings and revenue estimates for Q4, but showed a slight year-over-year decline in overall revenue and earnings. That's the kind of performance that keeps traders on edge. You're getting beats relative to lowered expectations, but the underlying growth trajectory is decelerating. That matters for valuation sustainability. Meta delivered solid Q4 2025 performance that resulted in a 10% stock price jump, demonstrating investor enthusiasm for companies successfully monetizing AI capabilities. The social media giant is converting AI investments into tangible revenue growth, which is exactly what the market wants to see to justify elevated valuations. Speaking of valuations, let's address the elephant in the trading room. The S&P 500 is currently trading at approximately 22 times expected earnings. The long-term average sits at 15.9 times earnings. We're trading at a significant premium that places considerable pressure on companies to deliver exceptional results. Any disappointment, any guidance miss, any indication that the AI spending boom is plateauing, and you're looking at potential multiple compression that could wipe out months of gains rapidly. This valuation concern is showing up in sector rotation dynamics. Despite AI enthusiasm, market participants are demonstrating increased caution. While high beta AI plays continue leading equity rallies, there's simultaneous shifting toward defensive positions in bonds and traditional safe haven assets. That dual movement tells you investors are hedging their AI optimism against potential economic or policy surprises. It's not full risk-on behavior. It's selective risk-taking with one foot near the exit. The broader economic backdrop shows inflation converging toward the Fed's 2% target, which provided support for the central bank's more dovish stance adopted in late 2025. But sustainability of this disinflationary trend remains a key variable. If inflation reaccelerates, if labor markets remain tight, if wage pressures build, the Fed could pause or even hold rates higher for longer than markets currently expect. That scenario would pressure growth stock valuations immediately. Recession concerns continue influencing market sentiment despite the AI-driven growth narrative. Analysts note that if the Fed's policy pivot is delayed, or if macroeconomic headwinds intensify, even high-growth technology stocks could face significant pressure. The AI supercycle thesis assumes a relatively benign economic environment. Remove that assumption, and the trade gets considerably more complicated. The upcoming earnings reports from major technology companies represent critical tests of the AI supercycle narrative. Market participants are focused on whether companies can continue delivering exceptional growth while managing margin pressures and operational challenges that are beginning to emerge. Revenue growth is great, but if it comes with margin compression, the market will reprice these names lower. The Federal Reserve's upcoming policy meetings will be closely watched for signals about pace and magnitude of potential rate cuts. Any deviation from the two-cut expectation embedded in current pricing could significantly impact the relative attractiveness of growth stocks versus defensive alternatives. If the Fed signals one cut instead of two, growth stocks sell off. If they signal three cuts due to economic weakness, that's also a sell signal because it implies deteriorating fundamentals. The Goldilocks scenario is priced in. Anything else creates volatility. What we're witnessing is a clear narrative battle shaping market dynamics. The AI-driven revenue growth story, exemplified by impressive numbers from companies like Apple and Meta, is being weighed against cautious Fed policy and persistent economic uncertainties. The dominant narrative will be determined by convergence of earnings performance and economic data over the coming months. Beyond the Magnificent Seven, market performance is becoming increasingly bifurcated. Concentration of gains in AI-related stocks raises questions about broader market participation and sustainability of the current rally if it remains narrowly focused. If you're seeing the S&P 500 making new highs but the equal weight S&P 500 lagging, that's a warning signal about market breadth deterioration. So which narrative wins in Q1 2026? The research indicates near-term market direction will be determined by the ability of AI-focused companies to continue delivering exceptional growth while managing operational challenges, combined with Federal Reserve policy decisions and broader economic developments. Investors are positioning for multiple scenarios, maintaining exposure to AI growth opportunities while hedging against potential policy or economic surprises. The current moment represents a critical juncture where promises of artificial intelligence meet the realities of financial markets and economic cycles. For traders, that means staying nimble, watching margin trends in upcoming earnings reports, monitoring Fed speak for any shift in tone, and respecting the valuation premium that's priced into current levels. The AI supercycle is real, but so are the risks. Position sizing and risk management matter more than ever in this environment. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.